Why does the stock market go down so much when interest rates are on the rise? This is on investors' minds right now as the Federal Reserve considers how much it's going to increase interest rates in 2022 and 2023, and it's really impacting market prices. So I want to get into why stocks go down when interest rates go up, because there is some logic behind this. Now, to demonstrate what the market is thinking here, I thought it would be useful to build out a model a little bit the way that a Wall Street analyst would do for a stock. So what we're going to do here is we're going to calculate the present value of 20 years of cash flows from a business. We're going to use really simple numbers, but hopefully this will help explain why asset prices go down as interest rates go up. The first thing we're going to do here is build out our cash flow model. So this is the year on the left here. And what I'm going to do is go from year 0, which would be the present, to year 20. So that way we have these numbers continuing to grow here. And cash flow, we're just going to have this be exactly the same every year from now until year 20, just to make these numbers really simple. Now the multiplier here, this is going to tell us what the present value of those future cash flows are here. And this is the formula right here. Present value of future cash flows equals the future cash flow itself divided by 1 plus the interest rate to the power is the number of years. So what this formula here is, it's 1 divided by 1 plus the interest rate, which I have up here in this blue box, to the power of years, which is the orange box right here. And as you can see here, this gets smaller and smaller each year over time. Now this makes sense because a cash flow of $100 20 years from now is not going to be as valuable as a cash flow of $100 a year from now. So it makes sense that those numbers would get smaller over time. We will also change this interest rate as we go forward. And you can see how rising interest rates makes future cash flows less and less valuable. Next thing I'm going to do is calculate the present value of all of these future cash flows. That's just simply going to be the $100 line times the multiplier line. Do that here and you see all of our present value of our future cash flows. And here is our asset value. This is just the sum of this entire column right here. So if I'm going to sell you an asset that is going to generate $100 per year, guaranteed for the next 20 years, you would be willing to pay $1,735 for that if your discount rate was 2%. So let's go ahead and put this in the table right here, 17, 35, 14. All right, so what happens to the value of our asset if our interest rate just goes up a little bit, if it just goes up to 3%? Now you can see all of these numbers went down and our asset value actually dropped to $1,500, $87.75. So this table does not start at 0, but you can see the asset value is dropping pretty rapidly. Let's go ahead and do this for 5%. Now we have 1346.22. That's about what has happened over the last 6 months, is an increase in interest rates from 2% to 5%. You've seen mortgage rates go from 3% to 6%, so about a 3% increase. So there's really some basis in the real world in these numbers here. Now we're getting a little bit higher here, but 8%. So this would be maybe a little bit riskier asset that we're valuing here. Maybe not a real estate deal. Maybe this is a stock. Now 10%, now we're getting into a little bit riskier asset. Now I'm only going to pay $900, $951 for these cash flows. And now 20%, this would be something like a startup. So if you project cash flows from a startup, I'm going to say, hey, maybe I believe you, but I want a really high discount rate because there's a lot of risk that goes into that business. So 20%, what happens here? Now those cash flows are only worth $586.96. So you can see here, this blue line is interest rates. As interest rates rise, the value of the underlying asset goes down. I do want to take a quick second to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insights and stock recommendations for investors of all skill levels and risk tolerances. And if you've been watching this channel, you know that I love researching stocks and thinking about what the strategy of businesses are long term and trying to find the next great investment. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular Stock Advisor service. Now, Stock Advisor isn't just any service, it's actually beaten the market by 240%. So go to fool.com/rive, fool.com/RIIV to get those 10 stock picks and get started. So what this is telling us from a stock market perspective is even if a company's earnings are going to stay exactly the same, even if their growth rate is going to be exactly the same, investors are going to value those assets a little bit differently depending on what the underlying interest rate is. Now, typically in something like the capital asset pricing model, which is a model that you learn in business school, they're going to find that discount rate based on what the treasury rate is and then what sort of risk premium you think that a certain asset should have. So that will change depending on what your model looks like, what kind of asset you're buying. Are you buying a startup? Are you buying real estate? Are you buying a growth stock? But this general trend here holds true. As interest rates go up, the value of the underlying assets goes down. That is why the market has been so focused on the Federal Reserve over the last couple of months. They're raising interest rates, but the market doesn't really know how high interest rates are going to go. Are short-term rates going to go to 3%, or are they going to go to 6% or 8% or even higher like they did in the late 70s and early 80s? That's what investors are really thinking about. That's why valuations have been so volatile over the last few months. Hopefully this table showed a little bit of what's going on behind the scenes because there is some logic to the market's reaction on a day-to-day basis. If you want some more information on the capital asset pricing model and some of the theory behind that, I will put some links in the video below. As always, if you enjoyed this, please subscribe to this channel for more information on both the stock market and disruptive companies, and I look forward to seeing you next time.